Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We're really going to drill down here into the jobs report right now. Jeffrey Cleveland with us with Payden Rygel. Love having him on with just an inherent optimism about waking up and taking a swim. We'll talk about that in a bit here. A ton of moving parts here to parse. Retail sales came in soggy except the control group. The control group takes out this, that, and the other thing, and it's a boom number of 0.8%. But Paul, the revisions on retail sales and the published retail sales is sort of just a mess.
Yeah.
Is how I'd put it. Your comment, Paul, on the 4.6%?
Yeah, looking at the 4.6%. I mean, we started the year at kind of like around 4% here, 3.9%. So it's definitely jumped a little bit there. Market lifting up a little bit. The yields come in a little bit as well. Again, maybe the most important statistic today, oil under $56 a barrel. We're giving Jeffrey Rygel about 4 more seconds here to parse the data. I'm going to say, folks, there's a single line here. Thanks to our great economic team, non-farm payrolls 3-month average change is 22,000. I don't understand politically, Paul, how 22,000 is okay for Washington. Yeah, exactly right, Tom. I mean, I think that's a little bit of a challenge there. It seems like at that no hire, no fire kind of economy still kind of with us to some degree.
Well, we'll have to see. We're commercial free for you through this half hour. We're going to continue here with Jeffrey Cleveland and get some good bond analysis as well. Bloomberg Surveillance this morning brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around the clock. And we thank Interactive Brokers for all their support. Michael McKee scheduled to be with us. Christina Kempmany will be with us on Invesco. But we continue now with Jeffrey Cleveland, who's at all of 2 minutes, 47 seconds to massage the data. What's the first thing you looked at, Mr. Cleveland?
I think, Tom, for me, the unemployment rate ticking up to 4.6, as we said in the preamble. I think that's going to get attention of investors and policymakers. I think you see that move in the bond market already. After that, I quickly looked at your non-farm payroll. I mean, I guess on a positive note, if you want the West Coast optimistic spin, you did have a negative October, but total private, if you exclude the government payrolls, didn't look too bad, Tom. You're talking about 52,000 in October. You're talking about 69,000 in November. You mentioned the 3-month average. We do like to look at that as well. And the Bloomberg economics team absolutely right. That 22,000, that's total non-farm. If you look at just private, it looks a bit better. It's 75,000. So right. I would still characterize that as soggy, to steal your phrase, your reference for retail sales. And I still think the risk here is a higher unemployment rate. And so I think this brings the Fed already back into play. We've got a lot more data before the next FOMC meeting, but I think the bond market will react, if I'm not mistaken.
I'm going to go to 3-month average, but Jeffrey, with your study at Claremont of politics, a 75,000 private statistic or a 22,000 non-farm payroll 3-month average, I don't care what flavor you are, Jeffrey Cleveland, that's politically unacceptable.
I agree. I don't want people. I do get messages from people, friends, family, and they say, it's okay if we have soft job growth, as long as the unemployment rate stays low. Well, bad news, everyone. If we have slow job growth, the unemployment rate tends to tick up, which is what we're seeing in the last few months. And I don't think 75,000 is politically palatable. I agree with you. So the risk here is additional rate cuts in 2026, and the bond market will start to sniff that out, I think.
So how do you think the Fed here? I mean, again, I'm looking at the WIRP function. We're kind of going in today thinking 1, maybe 2 rate cuts. Sure, I'm all over the WIRP function. How do you think that maybe changes in the coming days?
I think you're going to get more priced in. In our view, if the unemployment rate continues to trend up, and in our forecast, we do have inflation moderating. I think that's important to note as well. The Fed, we have, in our base case, the Fed cutting 3 times in 2026. So WIRP is probably underpriced at this stage. And that 4.6% unemployment rate bolsters that view, I think.
Well, let's jump ahead here. I mean, that's what Paul Sweeney wants, and I want, and Jeffrey Cleveland wants. Kent Benny's taking notes from Invesco over here. We'll get to Christina in a moment. But the bottom line, in 2 days, I get am I right? It's a legit CPI report on December 18th. Is that right, Jeffrey?
We get CPI on December 18th for November. So, I mean, definitely that'll be interesting to take in. We do think when we look at the main components of CPI, what we think will drive inflation in 2026, we think goods prices will cool off. We think non-housing services prices will also cool given the weaker labor market. And we do think housing has been a big thorn in the side of the CPI, the policymaker community. So we expect some relief in the housing component. So when we tie that all together, we do get core inflation trending back towards 2% next year. So that's kind of how we're looking at things.
Jeffrey, I mean, it's inflation again. We're going to hear some more inflation later on. We're hearing that maybe that cost of housing is coming down. How does that housing figure into just kind of inflation? Because for a lot of people, that's a big component.
Yeah, I mean, for the CPI, it's a big chunk. We're talking about a third of core CPI. It's a little bit less of an issue in core PCE, which is the Fed's preferred inflation gauge. But the data is slow and sticky, at least the government data. And we do see scope for the housing component of those indices to continue to cool off. That's good news. But I think it's more of the government data catching up with the reality on the ground. I think we've already seen in private sector metrics of rent and things of that nature a cooling in the housing component. But that should, people have said to me, we're sticky. Inflation is sticky. It's stuck at 3%. I think a portion of that is housing. As that cools off, core inflation will head back to 2%.
Jeffrey, I've been in awe of Paul Sweeney. He's out in a frigid wetsuit surfing in the ice-cold New Jersey surf.
Sure.
But Jeffrey Cleveland has outdone you.
I know.
He's done the 20-bridge swim in Manhattan.
Crazy.
He's done 20 miles to the Catalina Channel, probably tuned into the Dodgers while he did that. What's it like, Jeffrey Cleveland, swimming the English Channel? I mean, that's from our youth. That's amazing.
Well, it's cold. I mean, you're looking at about 25 miles from England to France. I think the day that I did the swim, it was 58 degrees at the start. So no wetsuits are allowed on that swim, otherwise you'll be disqualified. And so you do have one support boat, but you can't touch the boat. You can't take breaks. So you got to stay calm. You can't touch the boat. Unbelievable. You can't touch the boat because that's cheating. You just have. If you want to take a break, you do a back float, and someone throws you a little bit of a high octane Gatorade, and then you take a quick swig, and then you move on.
Do you see
it took
this
me about 10 hours to get across.
June or July. I mean, this screams Lisa Mateo. Can you see Lisa Mateo swimming the English Channel?
We did it in September, mid-September. That was the warmest. We thought that would be the warmest period for the water. What an accomplishment. It was still cool.
It's a triple crown of swimming. One of only 36
normal people don't do this. I don't know what Jeffrey's
36 people in the world have done. Jeffrey Cleveland, thank you for the insight on the jobs report and the spirit of that accomplishment of swimming around Manhattan is one of the things as well. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Paul Quincy's never seen this before. He's never seen a double jobs report. Wait, none of us have as well. He is global head of equities.
That's big.
For JPMorgan Asset Management. And you have the best single sentence. I hate outlooks. There's a guy, I don't know if you know Sam Rowe, R-O. He's in America, and his job is to read every outlook, including yours. We're going to get a report from Sam Rowe here. But I love, Paul, in your global note, you only have a belief factor in the equity markets forward. Only 9% of our investors are expecting above average gains in the market. Are we really that gloomy out there?
Good morning. I wouldn't call it gloomy. I would call it realistic. So when we look at the fundamentals drive markets, and to us, the fundamentals look pretty good. but you're really paying for it now. That's what's got our attention. And I think that note of caution comes in from a combination of, 23 times next year's earnings. We think the earnings are fine, but it's tough to see that 23 going up too much. And then you look at earnings have been a triumph of the optimists this year, yet again. But within the market, there's a lot of very optimistic thinking, particularly when you get into the small cap space. So those two things give us a little bit of pause for caution. So we think staying invested, sure, but you want to diversify by geography, diversify by style, and think about where the returns are going to come from, not just where they have come from in the past.
So in global equities, what's your U.S. versus maybe rest of the world allocation? Or how do you think about it geographically these days?
Yeah, so we do all that bottom up, right? We look company by company. And when you do that, you find it really hard to get too far away from the United States.
Yep.
So the US, on average, has better companies in better businesses. And that isn't going to change. The reason the US market is 2/3 of everything these days is it's come the right way, right? It's come through superior earnings growth over the last 15 years. So that's where we are. But you also now have higher prices. And I think you can legitimately balance your US exposure these days with the rest of the world. And we're not so sure investors are doing that. I think a lot of investors, including, by the way, investors in Europe and Asia, have kind of become a little over-fixated on the US and have forgotten you can also make money in those markets too.
Earnings. We've had some really good earnings out of the U.S. Companies here this year, particularly in the second and third quarter, double-digit kind of earnings. Looking forward, is the earnings outlook enough to support this market here?
Yeah, you need that earnings growth to continue when you're paying 23 times, right? Yep. But yeah, we think it is. When I look at forecasts, it's not just what the forecast is, it's where it's going. And our forecasts, all the work our analysts do, have been edging up all year. And they're still edging up. And most importantly, I think it's not just the usual suspects. So yes, these 7 incredible companies will yet again drive plenty of earnings growth next year. So we think S&P 270 this year, 310 next year. So we need $40 of extra earnings. We've got the Mag 7 down for $16 of that. So the rest of it has to come from the other 493. And I think that's happening. And we're seeing expectations edging up a little bit there as well. So, yeah, we feel good about the earnings part of it.
What do you do with cash? Paul was looking at cash. What did you ever get above 5% on money market funds?
No, but that was nice, though.
That was nice.
That was nice.
Yeah. And now it's 3.6-ish.
Yeah.
Have you seen a behavioral change in how we address cash? Stan Fisher would go on a percentage basis. It's 1.4 divided by 5. Wow, that's a percentage move. What's a change in cash appreciation?
Yeah, I think, look, investors have become more comfortable with this market. I think right now investors are pretty comfortable with stocks. Again, look at the prices they're paying. Look at the types of stocks people have been buying. The theme in the market this year has been that risk rules, right? The riskier, the better in some cases, particularly in small cap. That, again, makes us a little bit nervous looking forward. But do you want stocks over cash over any time frame? Of course you do.
Yep. So here, it's interesting here. Outside, what screens well for you guys right here?
The best returns on our platform, so we run a lot of strategies by style and geography. Yep. Best returns this year, international value. Cheap stocks and cheap markets. You made almost 50%.
European banks?
That's a part of it.
They're shaking at the JPMorgan digital experiment that Paul Quinsee is launching across Europe right now. The future of European banks. What do you see? Are you allowed to talk about that?
Yeah, of course. So look, first of all, the recent history of European banks, incredibly successful, right? So you've made a lot more money in those stocks, even in the much vaunted Mag 7 over the last 5 years. It's not that they've suddenly become amazing companies. It's that the market left them for dead. It took them 15 years to get over the damage inflicted by the GFC, but now they've restructured. They've got back to their core businesses. Interest rates have gone up a bit. Profitability goes up. If you go from being a left-for-dead company, just an okay company, you can make a lot of money.
Key question I had, this is my Davos question.
Oh boy.
Are they changing because it's a more Anglo-American management style?
Yeah, a little bit.
Relationship?
Yeah, I think they're more realistic. So rather than trying to compete in investment banking with some of those other guys that dominate those markets these days, they focus more on the local markets, on their cost. They've done a good job.
Paul wants to know, are you going to have as many food courts at your new palace in London as you've got on Park Avenue?
Well, we're still working on that. And as you know, the food...
What's the Greer's? Is that the little, like you're at Piccadilly and you can buy a Greer's little...
Yeah, that's right. Maybe we'll weave that in.
Do you have a Greer's?
Well, Tom, Paul's a graduate at University of Durham, which I just Googled northeast part of England. I found our spot, the Woodman Inn pub for you and I.
It is.
That's where we're going.
Absolutely.
There are many great pubs in Durham.
The Arab studies there, first rate, and the cathedral is arguably the best in the United Kingdom.
Yep.
Don't be a stranger. Come back. Bring your friends with you from JPMorgan. Paul Quinsee with us with JPMorgan here on an important jobs day. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Martha Gimbel's on fire. The Budget Lab at Yale's, I'm going to call it my think tank of the year. Their work on tariffs was frightening. We're looking for a tariff update here off of November from Martha. But right now, she's beginning what I think will be a Yale Budget Lab effort on AI. Martha, just give us the 3x5 card of the Yale Budget Lab study of AI and Lisa Mateo's future job.
Well, future, who knows? 5 to 10 years down the line could be anything. But at the moment, we're really not seeing AI showing up in the labor market overall. So, there's been a lot of Sturm und Drang, a lot of hype about how people are currently losing their jobs due to AI. And we're just not seeing that at all in the data.
Is there an expectation that we will at some time in the future? Because I just think about my early days on Wall Street. It seems like most of the tasks I performed as an investment banker can be done by AI.
It would be unusual, right, for there to be no labor market disruption when you introduce a major new technology. I think the thing that everyone keeps forgetting, right, is that it takes time for technological disruption to happen. It took decades for electricity to disrupt the labor market. It even took a pretty long time for the internet to kick in, right? It wasn't like immediately in 1997 we were changing all the things. And so, AI feels so big, and people are expecting to see, impacts immediately. That's just not how companies work.
So you don't have a guess out 2 years or 5 years. You're that blind.
I don't think any of us really know where technology is going. I will say, I think the thing to look for is a broader recession, because in recessions is often when employers take advantage of that opportunity to make, quote unquote, labor saving productivity enhancements. They fire workers, they, et cetera. And I think that's when we'll have a better sense of how AI could be impacting the labor market.
You led the charge from that Rose Garden moment in April on tariff analysis. What you and Ernie Tedeschi did was just an act of God. What did you fail at from April to December? When you look back, Martha Gimbel, what'd you get wrong? What'd you nail? What'd you get right?
Oh, my gosh. I do think that actually I'm going to pick a kind of nerdy thing here on tariffs. So one of the things that we got wrong on tariffs was that we didn't realize how many exceptions there were in the law currently for companies to take advantage of, that they weren't filing the paperwork for because it just wasn't worth it to them at previous tariff rates. But once the tariffs were high enough, companies started, for instance, filing the paperwork to take advantage of the USMCA. And so we've seen the share of goods coming into the US from Canada and Mexico that are exempt under the USMCA go from 50% to 90%. That is not something we thought about. That is not something we anticipated. And that is one of the reasons why tariffs have had less of an impact than many of us anticipated.
How do you expect tariffs to impact the economy, if at all, in 2026?
That's partly a question for the Supreme Court, and we're all waiting to find out. It's kind of interesting because, yes, we think that tariffs are slowing down the economy, but also if the Supreme Court overthrows the tariffs, that's going to throw much more uncertainty back into the economy because we're going to be back where we were beginning middle of this year with new tariff announcements every day. as the administration starts using other tariff authorities it's got. Kevin Hassett was just out there today saying they have a plan if the Supreme Court overrules them. So, I think my team in some ways is hoping the Supreme Court upholds the tariffs so they don't have to go back to doing tariff analysis every day.
Okay, just congratulations, this think tank of the year. You guys just absolutely killed it. I have no idea what you're doing for next year. Folks, follow Martha Gimbel, Gimbel. Follow her. And she's actually got a Twitter handle that makes sense. At Martha Gimbel. That works. How amazing. Yep. You got to go to Yale to do that. And it's a great feed of Furman Jed Coco's in here, Ernie Tedeschi's in here. I just can't say enough about following Martha Gimbel sort of on the linkage between markets and academics here and all this stuff that we mumbo jumbo about. Martha, congratulations to the Budget Lab at Yale. Just a spectacular year. We'll start the year off strong where there is as well. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Melting snow. We think that problem will disappear. Tell us about the newspapers, the challenges today.
Okay, here we go. So this is the wealthiest families in the world, kind of looking into them and how they have never been richer, and that includes the richest family of 2025. So this is according to Bloomberg. We're talking about, the founding family of Walmart, the Waltons. They top the world's richest families list again, a net worth that exceeds $500 billion for the first time. They own about 44% of the retailer. But the thing is, in this story, it's not just the Waltons. They say the 25 richest families, they're collectively $358.7 billion richer than a year ago, with a combined fortune of $2.9 trillion. A lot of things helping them: stock prices, demand for goods like metals, pet food, but also thanks to their experience they've kind of accrued over the decades. So that's what Bloomberg is saying. 4 families actually did join the list for the first time, but it just goes to show you how much more rich the richer are getting.
Well, the top 5 families, I'm just looking at the story, come from the Middle East.
Correct.
Qatar, Saudi Arabia, United Arab Emirates. So reflecting energy. There you go.
There
All right,
you
good
go.
for them.
Okay, now this is one way you can get rich. Okay, this is another way. This is in the New York Post. It's just another excuse to buy that pricey handbag. Okay, they say one of the most savvy investments you can make is a $12,000 handbag. Let me break it down for you.
Please,
okay, here we go. Okay, so they say the ultra rare Hermès Birkin, it could get twice its sticker price on the secondary market within 5 years. And the Kelly bag can climb 20 to 40% in value over the same period. Hope you're listening out there. Luxury resale, authentication, this platform, Open Luxury, they say the resale value of particularly the Birkin and Kelly bags over the past 10 years has outpaced gold. They say it's similar to buying a Picasso that you kind of hold in your home. And if you want the data, because we need the facts behind this, right? Okay. Birkin bags, they posted an average annual gain of 14.2% between 1980 and 2015. That beat the S&P 500's 8.7 and gold's negative 1.5% return over that same period.
I mean, do you carry these things out in public, or is it a piece of art that you put it in like a safety deposit box?
Yeah, it's like a Picasso. You just gotta hang it there and get your money back. That's what it's about, right? It's an investment.
I'm just fascinated here.
I just hope someone is listening.
Yes,
okay.
Exactly.
And this one is actually pretty funny. It was a Saturday Night Live spoof. It has now become a reality. So Saturday Night Live was making fun of, remember Spotify Wrapped? Like it gives you the breakdown of who your artists were, what age, your Spotify age.
Yours was Pantera.
No, it was not Pantera. So they did a skit about Uber Eats Wrapped, which is about discovering how much you spent on Uber Eats, your Uber Eats age, and also the most frequented restaurants. Take a listen.
Now you can find out which restaurants you couldn't live without.
Taco Bell, Five Guys, Burger King, Chipotle.
Guess that explains why the plumber's always here.
Yes. Okay. So the Uber has made it reality. Uber has now launched Uber. Okay. That compiles users' activity from across Uber, but also Uber Eats. So it will, yes, break down like what restaurants you kind of frequented the most. It goes across your Uber schedule too, like if you went for the Uber Comfort, how many things like that. It puts you in different categories. And yes, you can share it on social media with everyone, just at the click of a button.
Wow.
So check your Uber account.
My Uber account, the Offspring's Uber account, it's incalculable. The newspapers, Lisa, Mateo.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.